This is level 1 of the CFA program, the topic on financial statement analysis, and the reading on understanding income statements. As a standalone reading, this chapter is critical because it's going to give us a sense of the performance of a business. We'll start at the very top with revenues, and then we'll have expenses somewhere in the middle. And down at the bottom, we're going to have hopefully some net income that we can transfer over to the balance sheet. Now, we can't just view things in terms of individual silos. And so this is a critical reading because it's going to lay the foundation for us to become really good financial analysts, as we're going to learn throughout the CFA program that income, while important, cash flow is even more important. So in order to understand things like operating cash flow and free cash flow, we need to have a good basic understanding of income statements. And so as we go through these LOSs, you'll see words like revenues, you'll see words like expenses, and you'll see words like earnings per share. So there's the top, there's the middle, and there's the bottom of the income statement. Remember, what we're trying to do here is we're trying to measure the performance of a business over some time period. And that first LOS asks us to describe the components of the income statement, which I just did, revenues and expenses. But let's go ahead and get into more details here. So the income statement, oftentimes referred to as P&L, profit or loss, financial performance of a company over a specified period of time. We start at the top, and we have something called total revenues, and then we need to adjust those for things like discounts and returns. And then we're going to subtract something that we call expenses. And so let me go ahead and link this reading with a future corporate finance reading. We're going to learn, and I say this in pretty regularly, the goal of the business is to maximize shareholder wealth. And how do businesses do that? Well, they do it a variety of ways, but one way is to make something for pennies, right? Those are the expenses, and then sell it for dollars, and those are the total revenues. So as a good financial analyst, I always think in terms of the big picture, revenues minus expenses. However, remember, the Institute wants us to think like accountants, so we're going to have to group these things differently. And so look down at the bottom there, we can group the expenses by their very nature, like a depreciation expense, or we can group it by function, labor expenses or salespeople salaries, et cetera, et cetera. So here are the big components: revenues, which we've already talked about, expenses, which we've already talked about, and then gross profit. And so let me read that definition to you because I want to come back to it in just a minute. Amount of revenue available after subtracting costs of delivering goods and services. And then there's an operating profit and then a net income. So just think of these things as we're starting at the top and we're working our way all the way down to the bottom. And so we need to subtract these reasonable and these material expenses. We can take a look at Nike's 2021 income statement. And if you go to Yahoo Finance and type in a ticker symbol for any corporation, you can click down along the bottom and there's a link to financial statements. And you'll see that this is fairly standard here. So we start with revenues. So remember, from your economics days, revenues are price times quantity, P times Q. And then we subtract out what are known as cost of goods sold. And think of cost of goods sold as exactly what the name suggests. These are kinds of like costs of production. So what does Nike make? Let's just pick one of their product lines. They make sneakers. And so P times Q, that would be the 44, and notice those are in millions, so that's $44 billion worth of total revenues. And so how much did it cost for Nike to produce those things? Well, that's $24 billion. So what would go into cost of goods sold? Boy, what goes into the making of a sneaker? I guess there's leather, right? And there's rubber, and there's other kind of materials, right? What are shoelaces and sneaker laces made out of? Then you have labor and all sorts of other costs. And think of those costs of goods sold. Those are probably, if we were in a managerial accounting class, those would probably be like variable costs. So if you subtract those two, 44 minus 24, you get somewhere around 20. And that's called the gross profit. So let me go back to this one here. Amount of revenue available after subtracting costs of delivering goods or services. So you take revenues minus cost of goods sold. That gives you gross profit. And then we're going to group, here, let me go back here. Remember, these expenses can be grouped, right? So we're going to group these under research and development, which Nike doesn't look like they have any, selling, general, and administrative expenses, and then so that maybe other operating income or expenses, which Nike doesn't have. So there's 13 of that. Total operating expenses, that's 24 plus 13, so that gets us 37. Now, as a good financial analyst, and I teach my students this all the time, when I give them problems like this, I'll just give them revenues minus what I call total operating expenses, and that gets us down to the 37. So we subtract the 37 from the 44 to get us, what's that, about 7 billion in operating income. And remember, firms can call this different kinds of things. Sometimes you'll read operating income. Sometimes you'll read income from operations. But whatever it is, it's going to be 7 billion here for Nike. We can also call this EBIT, earnings before interest and taxes. Then we have some non-operating income or expenses, and this could be a whole bunch of different things. And we'll talk a little bit more specifically as we move through this slide deck and then the future slide decks. So there's pre-tax income of, and I'm not even going to say that number because look, there's a 6 and a 6 and a 6. You guys ever watch that old movie? Damien the Omen, don't read that number there. So we'll just skip along. So there's income taxes. That's almost $1 billion. So listen, don't ever let the politicians tell you that these wealthy corporations don't ever pay taxes. Right there it is. Nike pays income taxes of $1 billion. So there's income after taxes. And then a firm can have other income. They can have income from continuous operations, which is what that 5727 is. They can have income from discontinued operations, which Nike does not have in 2021. But these would be sales of product lines that they have either discontinued or sold or for some other reason. So down at the bottom, we have net income of 5727. So think about this. We're trying to evaluate the performance of Nike's executive leadership team. So the first question we ask is, what is the P times Q? So price times quantity, that gets us 44 billion in revenue. And then the next question is, well, how much did it cost us to get that $44 billion in revenue? And so notice we group these. We group these with operating stuff and then some financing stuff and then some other stuff. But these are all expenses. These are all things that are flowing out. These are things that take away from those revenues. And so at the very bottom, we're left with about 6 billion. Can I round up there? So we started with 44 and we ended up with 6. So there's our first measure of the performance of Nike and its executive leadership team, and then, of course, by implication, the board of directors. Now, as shareholders of Nike, what do we want? We want that number 44 to be as high as possible, right? And we want the total expenses to be as low as possible. What did I say earlier? Make something for pennies and sell it for dollars. And so one of the goals of the business is to generate lots and lots of net income. Now, we're going to learn as we move through capital budgeting that it's not so much the net income that's important, but the operating cash flows that's important. And we'll see in future study sessions the difference between those two. All right, let's go ahead and go back up to the top of the income statement and ask ourselves the question, when should revenue be recognized? And this might sound like an obvious question and an obvious answer. Well, we say something like, well, when we sell something and we get cash, well, that sounds an awful lot like it should be revenue. But remember what we learned in those first two readings in this study session that according to the rules in the United States and the rules outside of the United States, we use this principle of accrual accounting, which tells us that the revenue is recognized when it is earned. And so notice what we have in there. Risk and reward of ownership is transferred from us, the business, to the customer. And so oftentimes when we make this sale and we transfer that ownership, then we receive cash. But oftentimes we don't. We receive a promise to pay cash at some time in the future. And so that's when an accounts receivable is created. So even though we don't receive cash, we still recognize this according to the accounting rules as a legitimate revenue and one that should be recognized on the income statement. Now look at that second embedded bullet point. Let's suppose that the company receives cash in advance. And so instead of me selling you guys, my customers, instead of me selling you, let's say 100 Honeycrisp apples and you paying me cash, let's just suppose for some reason you say, you know what, Jim, I'm going to pick up my Honeycrisp apples next week and I'm going to pay you all this money today. So you pay me this today, but I haven't really transferred that ownership because I still have possession of the apples. And so that's a liability to me because you could call me the next day and say, you know what, Jim, I don't need your apples anymore. So if the company received cash in advance, a liability account, unearned revenue is created. And then, look, if the Institute wanted us to be accountants, what they would require in this next slide would be, hey, show us the journal entries for accounts receivable and unearned revenue and all that kind of stuff. But we don't have to put those journal entries together. We just need to know what they are. And so ultimately, we're able to figure out what does this mean for operating cash flow and free cash flow so we can use those measures of performance to value a company. All right, 5 steps to recognize revenue: identify the contract, identify performance obligations, transaction price, allocate to performance obligations. So notice there's our first indication of some kind of matching. Allocate the transaction price to the performance obligations. And then once we satisfy that performance obligation, then we can recognize it as a revenue. Now, what's super important here is that there are contracts. So these are legal and binding documents that can be enforced in a court of law. Performance obligations, these are just the promises to transfer goods or services. And the price, of course, is the price of the Honeycrisp apples or the price of, manufacturing a machine so that I don't have to stand up on a ladder and pick all of the apples out of the tree. Maybe there's a machine that can, shake the tree, and I can just stand under the tree and catch them with the... Anyway, that's a silly example, but you get the sense of this is really important, these 3 definitions: contracts, performance obligations, and transaction price. So let's finish this up here. Customer has obtained control when the entity has a present right to payment, right? Legal title, physical possession, risk and rewards of ownership, and they have accepted the assets. So I've sold you all of my Honeycrisp apples, and you have paid me cash. I don't really think there's a legal title, but we could probably put together legal title of apple ownership. You paid me, you have possession, and then you take ownership of the risk and the rewards, right? You can bite into that Honeycrisp apple, and what a great breakfast that would be. And then the risk is maybe you forget you have them and you leave them out on the counter, and the ants crawl around and eat your apple, and you don't want to eat it. My wife has a running battle with ants in the house, so that's why I used that example. A couple of other interesting things about recognizing revenue. Suppose that you and I agree to a transaction, and I'm a construction guy, and you want me to go ahead and to build, some kind of a massive structure. Well, we're probably going to use the percent of completion method because I'm going to ask you to pay me. And I'm probably going to ask you to pay me some up front. I won't ask you to give me the entire amount of the construction costs plus the price of whatever building that I'm constructing for you. But I may ask you to pay me today for a bunch of stuff. And that may not exactly match up with my construction costs. And so the accounting gods have come up with this percentage of completion method, which of course is based on, notice what we have in bolded, based on the stage of completion of a transaction or the contract. I mean, think of the crazy example. If for some reason that this building cost $10 million and you paid me $10 million up front, and I didn't get out my shovel and do any digging or my hammer and do any building, well, clearly that's probably not a revenue. So I need to wait until I get the shovel out and I do the hammering and I do a bunch of stuff. So then I recognize that revenue. And then you can do a variable consideration as well. Let's work through a percentage of completion example. So here we go. Build a machine for $5 million. It's going to take 3 years to build the machine. Cost estimated to be $3 million. All right, so this company XYZ is gonna get $5 million, right, over 3 years and incur $3 million worth of expenses. And so think about the choices that we have. Suppose we were using Jim's method of recognizing revenue. And so as soon as I got that $5 million, I recognized it as revenue. And then I didn't recognize that expense until year 3 or maybe year 4. Or hey, if it's Jim's method, maybe year 10. So what has to happen here, and I think you're getting the sense of this as we're going through, is there has to be a matching. You try to match the expenses with the revenues. All right, so at the end of the year 1, XYZ has spent $1 million. How much revenue will company XYZ recognize in year 1? So what are our choices? We could recognize $5 million, but we don't like that. We could recognize $0 million because we're not done, but we probably don't like that idea. So you understand that my point here is that you're probably going to recognize somewhere between 0 and 5 million during that first year, which means that we need to have some way to do it. And so that's this percentage of completion method. And you'll like this because it's super easy. So all we do is take the 1 million of expenses that we've incurred during the year, divide that by the total estimated cost. All right, so keep in mind that the estimate's probably not going to be right, but for now we'll live with the 1/3, and then we just take the 1/3 times that 5 million in total sales price. So there's our revenue recognition, 1.67. And this is a great illustration of this matching of expenses and revenues. And if you or I were trying to come up with a method of doing this, what did we say earlier? It's got to be between 0 and 5. This is what we have come up with. So hopefully what I'll do in these series of kind of accounting readings is I'll try to convince you that the rules that the accounting gods have come up with, they pretty much make sense. Maybe not all the time, but they make sense. All right, so we just got done with the top of the income statement, so let's move to the middle of the income statement. So a company recognizes expenses in the period that it consumes the economic benefits. Oh my gosh, what the heck does that mean? So the economic benefits means something like, okay, we've done all this work, and what do we get out of it? So if we've done all this work and we don't make any sales, we don't get anything out of it. So the getting something out of it is that sale. So that's the matching principle that I've been talking about. Matching principle, expenses are matched to revenues. Now, of course, you can have period costs, and you could say something like, you know what, if I pay my children to go out and pick Honeycrisp apples, and they pick 100 Honeycrisp apples today, and then we go down to the market and we sell those 100, well, that's a clear day-to-day matching. But what if I wanted to depreciate my Honeycrisp apple trees? I mean, I can't depreciate the entire Honeycrisp apple tree because, trees grow over time, I guess. And I don't think you can depreciate trees Anyway, but if I could depreciate that tree, maybe I'll do it over 20 years. How long does a Honeycrisp apple tree last? So period costs, like depreciation, what do we have in bolded there? They're less directly matched with revenues. And we're going to talk at length about depreciation as we move through level 1. All right, how about some specific expense recognition applications? All right, so let's suppose I sell my Honeycrisp apples. Lots of people pay me cash, but a handful of people say, you know what, Jim, I don't have the money today. I'll pay you next week or next month. So I recognize these as revenues, and I put together an accounts receivable. But of course, some of those people who owe me are not going to pay. Clearly, I'm not going to get 100% of the money that is owed to me. So how do we keep track of that stuff? Well, we need to put in this thing called a doubtful accounts. So using the matching principle, once the revenue is recognized, the company is required to go ahead and estimate how much of those accounts receivables will ultimately be uncollectible. And there are various ways to do this. I mean, the easiest way is just to go back over the history and say, okay, 4% of the people didn't pay me for the last 25 years. Probably 4% of the people are not going to pay me this year. And then warranties. I'm sure you guys know all about warranties. Whenever you go to a store and you buy something, almost anything, the agent who's checking you out says, now, would you like to buy a warranty for that item? And it's only $29 and it lasts you for the next 3 years. And I always politely decline these. But of course, companies have warranties, not just for smaller ticket items, but for bigger ticket items, like a car or a washing machine. And so what companies are required to do is to estimate those future expenses. So if we're selling 100 washing machines, what do we know? We might say something like, look, if something goes wrong over the first 12 months, we'll come out to your house and we'll fix it. We'll fix it for free. And of course, that warranty then increases the demand. Do I want to go back to that Nike income statement? I'm not going to do that. But the warranties then increase well, maybe not the P times Q, but clearly it's going to influence the Q. So how do we get more people to buy our stuff? Well, we attach a warranty to it, but then that implies that we're going to have some expenses, because if we sell 100 of these, 100 of them are not going to last a year without having something go wrong with them. So we need to just estimate those future expenses. And once again, this is why the CFA Institute has multiple readings on quantitative methods, so that we can figure out how to make these estimates, and then we'll do things like standard deviations and correlations, and those will be super fun conversations. All right, how about these long-lived assets or long-term assets? So think of the metal stamping machines that a company like General Motors or Harley Davidson has to manufacture their cars or their motorcycles. And so, of course, we're not going to spend $1 billion on this manufacturing facility and make 2 motorcycles, right? We're going to make thousands of motorcycles this year, thousands next year, and we're going to do this, hopefully for 10 years or 20 years or maybe over an infinite time period. And so we're going to depreciate these assets. Remember, depreciation is a non-cash expense. It's a non-cash expense that is tied to the initial cost of that asset. And so what we do is we spread that cost over some kind of a reasonable lifetime, maybe 5 years, maybe 10 years, maybe some other years. And we can compute depreciation in one of 2 ways. If an asset costs $1 million and it lasts for 10 years, we can use straight line depreciation. We can just take the million divided by 10 and give us $100,000 worth of a non-cash depreciation expense annually for that 10-year period. So notice we have number 1, straight line depreciation. Or we can use some accelerated depreciation methods. We could say something like, all right, it's going to last us 10 years. What did I say? It cost $1 million, but we're going to depreciate 40% of it in year 1, and then 20% of it in year 2, and then 10% in year 3. And so you have, just maybe a declining depreciation over time until you get the full depreciation amount, the cost of the asset. And so those are accelerated depreciation methods. What about non-recurring items? So discontinued operations. Operations which the company has disposed of or intends to dispose of. I think I've used the Procter & Gamble and the Jiffy peanut butter product line in a previous recording, but it's relevant here as well. Discontinued operations. So Procter & Gamble no longer does Jiffy peanut butter, so they have to report it as something that they say to us as good shareholders. They say, okay, look, we used to do this. We're no longer doing it anymore. And so here's the stuff. Here are revenues and expenses according to that stuff. And we need to report that as a separate line item under discontinued operations. And so notice that second arrow point. Both the international and US FASB require the company report separately in its income statement. We can also have unusual or infrequent items. I remember my professor when I was in college used the example. Now remember, I'm way older than most of you guys, so I was in high school during 3 Mile Island in Pennsylvania. Those of you who don't know anything about 3 Mile Island, go ahead, just type it in for a second. And there are lots of businesses that shut down with this, kind of release of nuclear material somewhere in Pennsylvania. And so my professor used this as an example of, unusual or frequent items. Businesses shut down, and so they presented this separately. And so notice some of the other examples. Employee termination costs, any kind of restructuring, whether it's capital structure or employee compensation. I mean, almost anything can go in here that is considered not a part of normal business operations. I'm guessing you guys are thinking, you know what, Jim, COVID is probably a good example in there. Now, remember what we talked about in those first 2 readings inside of this study session. We talked about generalities and we talked about standards. And so both the international group and the US group, they have these standards, and they say, all right, if you're going to do depreciation, just pick away and just use depreciation method like that, for the rest of your life. Well, of course, we have the option to change depreciation methods or any of the other methods. And so we can change accounting policies. So we can handle this one of 2 ways. We can say something like, all right, we're changing from straight line to accelerated, and we need to go back and restate all of the financial statements all the way back for the last 10,000 years. Well, I mean, that's not too terribly practical, but we probably want to restate it retrospectively for, the last handful of years. Or we can just say, you know what, we're making the change, and then we're going to do this going forward. But the accounting people think in the following manner, and this is probably pretty reasonable. If we have dramatic changes in accounting policy from last year to this year, well, shareholders and financial analysts and anybody interested in evaluating the performance of our company is going to look and see, okay, we did it last year this way. We did it this year using this other method. Last year was 100. This year it was 10,000. And we're scratching our heads thinking, okay, what's going on? So it's a lot easier to go back and say, look, here's the financial statement last year. If we would have made those changes last year, and that 100 is really 9,900. And so now it's 10,000. And so people say, oh, that makes perfect sense. All right, we're focused on this middle of the income statement now. Operating income or income from operations, any financial activity resulting from a company's core business. Oh, I love that word, core business. And so this is what I was talking about earlier when I said make something for pennies and sell it for dollars. So really, that operating income is a first measure of the quality of the ability of the managers to generate some kind of an income. What do we want to do? We want to have lots of revenue and we want to have minimal expenses. So that operating income is going to give us a sense of the performance. Remember, this is in the middle of the income statement. Now, the CFA Institute might ask you a question about the difference between operating income. So in the U.S., operating activities, including all transactions and other events which are not defined as investing or financing activities. They're generally producing or delivering goods and services, so they have to fall in the U.S. under operating activities, but the International Board doesn't really provide a definition of operating activities. Although when you look at this statement of performance for international firms, according to those rules, you get a sense of what operating activities might be. And then, of course, companies can generate income in other ways, just like you and I can do this. And so these include revenues and costs that are outside of those core businesses, which could be all sorts of things, like one-time sale of property, that would result in a capital gain. This would produce a non-operating income, but there's all other sorts of stuff that can go inside there. And we'll take a look at that as we move through this. So here's a good example, Atlanta Oil. So there's sales, there's cost of goods sold. So there's gross profit of $225. Remember what I said earlier, think of those as kind of the variable costs. And then these operating expenses, these are kind of like the fixed costs, although they might not be exactly fixed every year, but they're kind of nearly fixed. So salaries and rent and utilities, we spend about the same amount on that every year, and we spend about the same amount every year, regardless of what those sales are. So they're kind of fixed. So there are total operating expenses, and that gets us operating income of 94. So we have this non-operating, which we talked about on that previous slide. So we can have interest revenues. I mean, there's no reason that Atlanta Oil can't go out and buy a municipal bond and hold that municipal bond and get interest. Or Atlanta Oil can say to somebody like, maybe Jim's manufacturing plant, hey, we'll sell you all this oil. And I might say something like, well, you know what? I can't really pay you right now. So Atlanta Oil might say, you know what? Don't worry about paying us now. We'll lend you the money. So they lend me the money and I repay the amount I owed, and then I'll have to pay interest. So there's some kind of an interest revenues in there. And those gains can be capital gains. Interest expenses can be almost anything in there. Losses on sales of property. And make no mistake, I mean, you can throw things like gains or losses on derivative contracts in there. Foreign exchange gains or losses can be thrown in there. And so look at the bottom, you get 95 for net income. The next question we have to ask as good financial analysts is, where does that $95,000 in net income go? Remember, shareholders, they are the owners of the business. So they have a claim on the earnings stream of the business. And also remember that this is a credit balance on the bottom of the income statement, and accountants do not like to have hanging debits or credits. So we need to do something with that. So what we do is we take that 95 in net income and we waddle on over to the balance sheet and we throw it into the total equity portion of the balance sheet. Remember, total equity represents the ownership of the business, and so that's where shareholders reside. So the question then becomes, how do we use that as a measure of performance? And what we're going to see is that both U.S. and the international boards, they require that a company presents its earnings per share on the income statement. So let me just go back here quickly. To get earnings per share, we're going to take that 95,000 and we're going to divide it by the number of outstanding shares. So you might think that this is a pretty simple calculation, and for many corporations, it can be. But we need to ask ourselves the question, does the company have a simple capital structure or a complex capital structure? And this is an easy answer. A firm has a simple capital structure if it does not have any outstanding securities that are convertible into common stock. What did I say back here? We're going to take that net income and we're going to divide by the number of outstanding shares. Well, some companies have a bond that can be convertible to common stock. Some companies have preferred stock that can be convertible to common stock. And some companies award their upper level and even middle management team what are known as stock options, which of course when exercised then can increase the number of outstanding shares. So let me just repeat myself here. A simple capital structure is one that has none of those securities. A complex structure then is a structure that does have some of those convertible securities. So let's just start with just the general basic earnings per share, which would apply to those firms which have a simple capital structure. So if I'm writing these questions for the Institute, that's going to be a line that I have in the question stem. Here's a company, it has a simple capital structure, so then boom, you automatically think of this formula right in the gray box. So all we're going to do is take that net income, that 95 back there, subtract out any preferred dividends, and the Institute would have to give you preferred dividends inside of the question stem, and then divide by the number of outstanding shares. Now, remember that the number of outstanding shares is kind of a fluid number. And so rather than just take the number that we have today, we're going to take an average, and it's going to be a weighted average. And so if I remember correctly from my intermediate accounting days, a long time ago, that you could compute the weighted average number of outstanding shares over almost any time period. But I think the convention is just to say, okay, we had 100 outstanding shares last year, we had 110 this year, let's just divide that by 2 and go with 105. Now, one of the interesting things that I'll say to you is if you look in the reading and in the end of chapter questions, you're pretty much given the weighted average number of outstanding shares. So you won't have to compute that. And in fact, the LOS doesn't even ask us to compute. And so just remember, we're weighting those number of outstanding shares in the denominator. So we take the 95, subtract out whatever the preferred dividends is, and then subtract out whatever that weighted average number of shares. So that gives us basic EPS. I will editorialize here for just a second and say, as a good financial analyst, and hopefully I'm going to convince you as we do level 1 and level 2 and level 3 over the next handful of months, is that, boy, wouldn't it be nice if these accounting bodies would require operating cash flow per share. But as good financial analysts, we can easily calculate that. All right, so let's work through those 3 examples that I just said. What happens if a company has convertible preferred stock? So all we do to get the earnings per share, and notice what we call it, and this is taken right out of the reading, this is called the diluted EPS. So we're going to take the net income. Now this is just with preferred stock, and we're going to divide by the weighted average number of shares outstanding, just like we did before under the simple structure. But then we have to add something. So notice in the denominator, there's a plus sign. And these are the new common shares that would be issued if that preferred stock were converted to common stock. So think of that denominator as kind of like, the actual number of outstanding shares plus the potential increase in outstanding shares. And of course, it's called diluted because when you increase the denominator, you're automatically going to decrease the earnings per share. Now, when a company has a convertible fixed income security, the calculation is very similar, but there's a couple of subtle differences here. We're going to start with net income, but we're going to subtract out the preferred dividends, of course, but then we're going to add in the tax subsidy. So notice what we have in the middle there, the after-tax interest on convertible debt, because we get to deduct any of those coupon payments or those interest payments on the income statement. So we do have some kind of a tax implication for convertible debt. And then we're going to divide by that same weighted average number of outstanding shares. And there's another plus sign, right? The additional shares that would have been issued if those bonds would be converted to common stock. So just like above, we have in the denominator the actual number of outstanding shares plus the potential increase in outstanding shares. Now this third one is clearly more complex if we have stock options or warrants. So notice what happens here, that the executives have the right but not the obligation to buy shares of stock in the company in which they work, right? And so we do the same thing in the numerator, but we're going to add, what are we adding here? Boy, new shares that would have been issued at the option exercise minus the shares that would have been purchased with the cash received. Because remember, the executives, they're buying these shares of stock. So they're not converting, they're actually buying. So the executives, they pay cash to the firm and they get these number of outstanding shares, which increases the number of outstanding shares. And then we have to adjust it by the proportion there in the denominator. That's why there's the multiplied sign. So I think those three, here, let me go back here. So the 1, 2, 3. I think those three equations, if you memorize those, you'll be able to answer any LOS that asks you to describe. Now, one important concept, if you look at the bolded arrow point in the bottom left, is that the reading calls this thing here, the stock options or warrants, this is the treasury stock method, because typically what's happening is that the executives over time have repurchased shares of stock, just like we can purchase shares of stock. So they retire some shares of stock, and that goes into an account called treasury stock. And so when executives buy stock options or exercise their stock options, they take those shares that are in treasury stock and sell them to the executives rather than issuing new common shares. I don't know if that's too terribly important, that distinction, but just remember, this is called the treasury stock method. Here we go. Know the difference between dilutive and antidilutive securities. So dilutive securities are those that will dilute or decrease the earnings per share, much like we have described in those previous three examples. However, there can be antidilutive securities in which the EPS results in an increase after considering these particular securities. Now, the antidilutive securities, this is kind of a rare event, and most of the time it occurs when one of those convertible bonds or convertible preferred shares are either swapped out during some complex transaction or they're retired. Some of those have call features, so they could be called back by the company. Notice the circle point there. Under both U.S. and international financial reporting standards, antidilutive securities are excluded from the calculation ones, but the diluted should always be included. Now, how about these common size income statement? Really, all we're doing here is saying something like, okay, if we're comparing, what do we have? We have a Nike balance sheet and we have an Under Armour balance sheet. And so maybe those two balance sheets look an awful lot alike from an organizational standpoint, but from an account balance standpoint, maybe they're completely different. And so, what we want to do is put a common size income statement, which says something like, okay, Nike has cost of goods sold that is, let's say, 75% of revenues, and Under Armour might have 62%. Well, the common size income statement will be able to make comparisons across both time periods and across companies. And so notice what we have in parentheses there. Oh my gosh, you guys are going to love this, especially when we get to level 2. We're going to have great conversations on time series analysis and great conversations on cross-sectional analysis. This is under the general heading of regression analysis, and this is an extremely critical tool that we can use in quantitative methods to, are you ready for this? Evaluate the performance of a company. So notice the benefits. I just said this here. Meaningful comparison and highlight differences between company strategies. All right, how about if we look at a handful of financial ratios? Let's look at net profit margin. What are we trying to do? Remember, we're trying to evaluate the performance of the executive leadership team. What do we want to do? Make something for pennies and sell it for dollars. Well, why don't we have a ratio where we take a look at the very top of the income statement versus the very bottom of the income statement? We call this net profit margin. So we have net income at the bottom, all the way up at the top, revenue. And so what do we want? I mean, we want lots and lots of net profit margin. We can compare Nike's net profit margin to Under Armour's net profit margin, and we can reasonably make the conclusion that one is probably going to be higher than the other. Then this is how cool this financial ratio analysis is. Once we decide that either Nike or Under Armour has the superior net profit margin, then we can go ahead and use all of the tools from the CFA program to ask and answer the question, why? Just because a company has a higher net profit margin doesn't mean that it's superior than the other company. We need to figure out why this is true, so that we can determine which of those companies is going to perform better in the future. That's what we're all worried about. Gross profit margin, on the other hand, is, let's take a look at something that's on the middle of the income statement versus what's on the top of the income statement. So we have gross profit, which, remember, is just revenues minus that cost of goods sold divided by revenue. So of course we want to have a higher gross profit margin. So let's go ahead and take a super simple example here. Gross profit margin for both periods. And so what are we going to do? We're going to take the, 25 minus 12 and the 17 minus 6. We'll just subtract those two divided by the 25 and the 17. So those are easy calculations, 64% and 52%. Let's take a look at the difference between total comprehensive income under the international standards and comprehensive income under the U.S. standards. So total comprehensive income, right? Total comprehensive income under the international standards. And let me go ahead and read this to you. Change in equity during a period resulting from transactions and other events other than those changes resulting from transactions with owners in their capacity as the owners. So think about that as exactly what we've been talking about a little bit before when I said that net income gets thrown over into the total equity. Now, under U.S. GAAP, comprehensive income is that, let me read this to you, change in equity of a business enterprise during a period from transactions and other events and circumstances from non-owner resources. The important difference here is it includes all changes in equity that result from investments by owners and distribution to owners, right? And so those are the big two differences, international and U.S. standards. All right, so let's go ahead and compute a firm's comprehensive income. So look up at the top. We start with 500 in shareholders' equity, and then what do? We've got net income from the income statement, and then out of retained earnings, we pay 5 as a cash dividend. All right, and then we didn't repurchase any of its stock. So you see the important application of those two differences. Let me read that top to you again. Other than those changes resulting from transactions with owners, and then here include under the GAAP, including all changes that result from investment by owners and distributions to owners. All right, so this answer here is pretty straightforward math. We'll start with the 570, and then we're going to subtract out. What do? We're going to subtract out the beginning shareholders' equity. We're going to add the net income, right? We're adding net income from the income statement. We're pay out $5 million from retained earnings. So that gives us $25 million. So total comprehensive income is going to be net income plus other 25. So there's the 75. All right, remember I said earlier somewhere in a previous slide, I said something like you can throw a bunch of stuff in there. And I'm not sure exactly what were those categories that I was talking about in that earlier slide. But here we go. Foreign currency translation adjustments, unrealized gains or losses on derivative contracts. Remember that these corporations, they use forward contracts on their international transactions, and so there's going to be a foreign currency translation adjustment for stuff that goes on today, but then they use a derivative like a forward contract or maybe even an option or a futures contract, And so they have to report those gains or losses, and sometimes they're realized and sometimes they're unrealized. How about available for sale securities? Remember, corporations can own, bonds and shares of stock just like we can, and so they have to report those unrealized gains and losses. And then, of course, this doesn't really show up in too much detail in the CFA program, but we will have some conversations on retirement plans, and so we have to have an awareness of the costs associated with a pension fund. And that takes us through all of the understanding the income statement. So what do we do? Here's my advice, and there's the second part of this. Here's my advice. Start at the top, revenues, work your way all the way to the bottom. And then, of course, you need to worry about earnings per share and common size statements and financial ratios. But start with the income statement, start at the top, go all the way to the bottom. Ask yourself the question, what am I doing at each one of these steps? And if you answer each one of those questions, I think you can answer these any CFA Institute question on the exam. So, as always, thank you for watching, and good luck studying.